Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence-based holistic insights to help you master the game of building wealth. Okay, so let's get into today's Q&A session. And the first question is from Matt. Matt writes, thank you for the breadth and quality of your material you discuss on your podcast. The podcast was recommended to me by a work colleague about a year ago, and I've been absolutely hooked. I even went back and listened to the older episodes. So thanks very much, Matt. And in fact, for any new listeners, if you're wondering about a particular topic, chances are I've written a blog or produced a podcast episode about that topic. So it's always good to, maybe have a search for that if you've, got a question or you're contemplating something. Anyway, Matt writes, you've mentioned in the Q&A episodes previously the difficulties the financial planning industry is facing recruiting new advisors in light of regulatory changes and so forth. I'm a CPA with experience in senior roles across financial control and commercial finance overseas, and in Australia have been toying with the idea of qualifying as a financial planner for several years. Firstly, because I enjoy the subject and would like to learn more, but also to explore a career change. I'm now 43 years old, nothing to do with the midlife crisis. Do you have any good recommendations about study options for someone interested in joining the industry? And more importantly, from your experience, what are the key attributes, skills, or behaviours of a successful financial advisor? Thanks again for your awesome contribution and building financial acumen for all of us. Well, Matt, it's a great question, and thanks for asking it. Yes, the financial planning industry is absolutely struggling to attract new advisors. The barriers to entry are much higher these days with you need to complete a bachelor degree in financial advice, and then you need to have a professional year, so you need to train under someone. Both of those requirements are, I think, reasonable. I don't think it's unreasonable that we should expect that level of, kind of the same level of training that an accountant, for example, has to do that. In fact, they do postgraduate study as well to qualify as a CPA or CA. So that's fine, but I guess the industry has changed over time, and about half of the advisors have left the industry over the last 5 years. But I don't think, that's terrible for the industry at a macro level, but arguably those advisors' probably core competency was salesmanship rather than advice. So that's fine. I think they probably sort of deserve to leave the industry in some regard. But the point is we've got, not enough advisors to look after all Australians, which is a negative for Australia as a whole, but a positive for anyone that's looking to actually join the industry, because finding a job and finding clients will be a lot easier in industry that's undersupplied from a human resource perspective. Coming back to your question, Matt, I would say intellectual curiosity is probably one of the key and most important attributes of an advisor. And it's something when we hire advisors in my firm, something we really look for, and it's critical, to constantly sort of think about things and think about methodologies and think about approaches, and not try and be different just for the sake of being different. If it works and it's something that we've done for many decades previously and it continues to work, fine. But let's not stop critiquing it. And let's keep asking ourselves, what is the best way to do things? To develop strategic advice, which is really another way of saying to develop a long-term financial plan for someone. It's a little bit like a puzzle. You've got to put a puzzle together. Everyone's situation and goals are different. Everyone's sort of financial position is different as well. And it's really about building a puzzle. How can you use those attributes to, create wealth over time? And so you need a good level of analytical skill as well. That's really important. So, a logical thinker. Most people that are attracted to accounting are kind of logical thinkers anyway. So you probably fulfill that role, Matt. And then I think a real connection with helping people is super important, because if that's what really gives you that reward from the job, and it does for me, putting the money aside, if you just do something for money, in my opinion, that's not doesn't have any longevity. You need something more than money. And the thing that I get, the enjoyment I get is meeting a client today, developing a long-term plan for them, and then seeing how that plan works out, and then in 20 years' time looking back and going, yeah, we've really helped that client. Now, they've done a lot of the work as well, of course, but the advice we've given them has certainly put them in a massively different position. And so if you really connect with the value of, that sort of relationship, I think naturally you're going to want to do a good job. And as a result, I think that makes a great advisor. But intellectual curiosity, I think, has to be the biggest element. And I would say I've met a lot of financial advisors, obviously, through the recruiting process. I would say a lot of people don't have a lot of intellectual curiosity, to really dig deeper into something in terms of, it's something even technical, like how does hedging work in some funds versus other funds, and how does that affect the components and taxable components of the distribution? A lot of advisors haven't delved into that detail, and that's just only one example, I guess. But great question, Matt, and thanks so much for the feedback also. By the way, I should apologise if my voice doesn't sound quite normal. I've somehow managed to get the flu in the middle of summer in Australia. So I don't know how. I did a bit of travelling over the Christmas break, but maybe I picked it up there, so apologies for that. Okay, so next question is from Sam. Sam writes, back in 2020, right before COVID, I bought an established one-bedroom unit in the Ryder area as I wanted to get into the property ladder, and this was the best asset I could afford at the time. I've since moved out and got married, and we've had our first child, and so we've been renting for the past few years. My income has increased significantly since 2020, so my wife and I purchased a 2-bedroom unit in a blue-chip suburb of Sydney. We can afford to keep the 1-bedroom unit, but it'll cost around $985 a month to hold. With young children and my wife working part-time, cost of living is fairly tight, and we don't have much in the way of savings to purchase after purchasing the 2-bedroom unit. Would it be better to sell the 1-bedroom unit and make the monthly expenses more manageable, allow for savings as well as holidays, and put the profit into the offset to repay the loan against the 2-bedroom unit faster, or should we hold on to that property as we'll be better off in the long term? My concern is the quality of the asset. Being a 1-bedroom unit might not be enough to sacrifice our quality of life in the medium term or until rates drop. I purchased the unit for $445,000 back in 2020, and it's now worth approximately $475 to $495. Rental yields around 5%. I'm in two minds and I'm experiencing analysis paralysis. Please help. So Sam, great question. That's the thing with property is, and it sort of goes against what I say in this podcast many times, which is play the long game. With property, sometimes you can only do what you can do. So, back in 2020, your income was at a certain level. That's what you could afford. Which is fine, and that's the right approach, and you get onto the property ladder and it's done its thing. You got into the market. And in a way, it provides a sort of forced savings mechanism, doesn't it? Buying property, you've got a commitment, and therefore you're forced to put your money towards that commitment. It's not unusual, though, for young people, they first buy an asset and 2 or 3 years later, their financial position and capacity can be in a massively different position. And so that's not uncommon. And so what you need to do then is make the best decision today, of course, so that you'll be better off in 10 years' time. And the key thing here is the growth and quality of the asset. And I think you've hit the nail on the head in terms of the 1-bedroom unit. If you set a 1-bedroom unit in a fantastic location, a blue chip suburb of Sydney, I'd probably say the location offsets the fact that it's only got 1 bedroom. If it's a 1-bedroom unit, but it's not in a blue chip suburb in a, very built up, well-established capital city, then you've got some problems. You've got 2 problems, both the locality of the asset in terms of supply and demand, and the ability to increase the number of units in that location. And also the one bedroom element, which I weren't prior to COVID. I wasn't necessarily that negative against one bedroom units, but I think now, because a lot of people will look for space to work from home, I think that puts one bedroom units at a disadvantage post COVID. So of course I don't know, the intricate details of your situation, but based on what you've told me, I would probably be inclined to sell the one bedroom unit on the basis that if you're in the position that you are today, you probably wouldn't have bought it, right? And it's not your fault that your income has changed. As I said, you've got to kind of make the best decision today based on the data you've got, but realize with property, your situation might change in 3 or 5 years' time. Don't let the past decision restrict your ability to make the best decision today. And, of course, you should never sell property. That's the idea, or that's what people tell you. You never sell property. But it really should be never sell investment grade property. And I think that's the key here, is the one bedroom unit in Ryde probably isn't investment grade. Okay, the next question is also from Sam, a different Sam, however, of course. I won't read out the question because it's quite long, but Sam's really asking me to do an episode on buying a commercial property inside a self-managed super fund. And he gives his situation as a bit of a case study. So I've added that to the list, and I might consider writing that blog in the future. It's a bit niche, but still worthwhile, I think, exploring the topic. Particularly if you're self-employed, Sam is, and the business, the commercial property he would like to buy is where he operates his business from, as far as I understand. So that's a consideration as well. I mean, of course, Campbell recorded episode 337 on the 1st of January, in fact, talking about the liquidity trap with buying property in super. So Sam, that would be the first thing to think about is, firstly, you're probably borrowing 60 to 70% of the value of the asset. So you're going to need to have a pretty sizable deposit as a contribution in terms of super. And then you're going to have to consider the cash flow impact. And of course, you can, to some degree, manage that by the rent that you pay into the super fund. And so that gives you some level of control or assistance. But it's possible that you'll put all your money into this property, and in fact that the servicing costs will also soak up all of your money, and so you're kind of all in terms of all your super is invested into this one asset, and you've got to think about, is that a good investment decision? You might like the idea of owning the premises that you operate your business from, but that could be more of an emotional benefit rather than anything else, or a benefit to the business. You've got to really think about de-risking your situation. And I like client super to be invested in a way that has no linkages with their income, or business. So if the income or business, or their career or business don't work out, at least we've safeguarded retirement savings. And then, of course, as Campbell talks about, the liquidity trap. So you really want to do some long-term planning around it. I think Sam said he's 36. So he's still got a bit of a runway until he can access super, 14 years or so, but still that's going to be an issue. Like by the time he gets to 60, that property is still probably going to make up the lion's share of the assets of any self-managed super fund. And so that's something that he wants to think about. A blog would be a good idea, but the problem is that a lot of these situations, there's always idiosyncrasies and differences. And this is where I talk about holistic advice, because you might come to me and ask, Stuart, should I buy a property, my business premises in my self-managed super fund? But to answer that question, I really need to know, everything about your situation, what your long-term strategy is, how your cash flow looks. It needs to be a holistic viewpoint for me to know enough to say yes or no. And that's why that sort of piecemeal advice approach doesn't really work, which is to say it's doable from an advisor's perspective. But I think from the client side, I think that there's too much risk that things get missed, and therefore I don't think it's worthwhile paying for the advice, because you're not guaranteed that the advice is going to be right unless it's holistic advice. So thanks for the question, Sam. I'm sorry that I couldn't answer that in more detail, but hopefully that gives you some things to think about. Okay, next question is from Lincoln. So not a Sam this time. Good to have a change. Lincoln writes, my wife and I are 46 years old. We have a combined income of $300,000 before tax. Our only daughter, 20 years old, has left home. Good on you, Lincoln. And she's not dependent on us, except for a small amount he pays into an ETF and she matches that contribution, which is kind of good to get kids started and interested in investing. Lincoln continues to write, we have $220,000 left on our home loan and pay $3,500 a month. With these repayments, we'll have it repaid in less than 3 years. Our home is in regional Queensland, valued about $1 million. Our only assets are our home, $54,000 in shares and ETFs, and our super. We've got a combined $1.5 million of super, similar balances, and we maximise our concessional contributions of $30,000 a year through salary sacrifice contributions, and we also add about $13,000 a year each in non-concessional contributions, $500 a fortnight. We plan on increasing our non-concessional contributions as our income increases. We project we'll have $3 million of super by the time we reach 60. So my question is, once the home loan is fully repaid, can we remortgage for, say, $600,000 and invest $450,000 of that in a growth ETF portfolio and keep $150,000 as loan redraw? According to loan repayment calculators, as long as we continue to pay the interest on the $450,000, the loan balance won't reach $450,000 for 13 years as the repayments eat up the $150,000 redraw. I think I'm a bit confused here, Lincoln, but I think what you're suggesting is set up the $600,000 loan as a principal interest loan and let the redraw repay the principal and you pay the interest. You could do that, or actually probably better to set it up as an interest-only loan. And so that's all you need to repay is the interest, and then you can set up that loan for $450,000, whatever you want, or keep the $150,000 in redraw. Anyway, Lincoln goes on, in 13 years' time, I'll have access to my super. The idea would then to be repay the loan to clear the mortgage. We would hopefully have a capital growth on the ETF portfolio and receive tax deductions along the way due to the negative gearing. I've been thinking about this strategy for a while and thought it would make an interesting case study. I know I may be able to get an interest-only investment loan, but wasn't sure whether you could get an interest-only period for at least 13 years, nor would the interest rate be as low as a home loan interest rate. Okay, so let's talk about the loan stuff first, because that's kind of the easiest. You're right, an interest-only loan attracts a higher rate. An investment loan attracts a higher rate. So you could go to the bank and say, I want $600,000 as a home loan on a P&I basis. Problem with that is that that's called cash out, because the bank's just giving you that money and they'll want to know what purpose you're using it for. And as soon as then you say, I'm going to use it to invest in the stock market, the bank's going to turn around and say, okay, we need an investment loan. So then the question is, do you have an investment loan on a P&I basis, or do you have it on an interest-only basis? Well, you could have it on a P&I basis, and as you suggest, Lincoln, leave money in redraw to fund the principal part of the repayment, and you just repay the interest from your own cash flow. That could work, right? And it will kind of just eat away at itself, and that'll give you kind of the same outcome. It's a little bit finicky, like in terms of, transactions, but if you're on top of it, it's fine. A simpler solution, albeit more expensive, would be just to have an interest-only loan. So what you're suggesting there is fine. Now, with respect to the strategy, which, your strategy, as you've put it in the question, is you're going to retire in 14 years' time because you're 46, retire at 60. Should you go out and borrow a whole bunch of money and put it into the stock market? Well, I calculated that. So we've got to think then, okay, your cost of debt is going to be somewhere between 6 and 7%. I mean, it might be lower on average over the next 14 years, but if I'm going to do some numbers, I want to be conservative, and I'm going to say it's going to be in that range. So let's say 6.5% as a kind of midpoint of that range. You certainly want to earn more in terms of compounding returns over that 14 years to make it worthwhile, but let's not be too ambitious. let's say 10%. I would say 10% as an aiming return is relatively ambitious, but you want to be rewarded for, the risk of borrowing to invest in the share market. So then what we need to ask is, what is the probability of earning 10% off the share market over the next 14 years? It's around about 70%. So you've got a 70% probability. So it's not a fait to complete. And obviously, the longer the time you have, the higher the probability. So it's 85% over 30 years, for example. That kind of makes it, or puts the balance of the risk in your favour. Of course, 10% is, the long-term average. So it's not an unrealistic expectation, I guess. In your situation, the question I would be asking myself is why? Why would you take that risk? If you've got $3 million of super by the time you get to 60 and no home loan, the question would be, how much do you want to spend in retirement? Because I did a blog a while ago looking at or analysing how much you need to spend in retirement. In fact, have a look at episode 314, published on the 24th of July, 2024, so last year. In that episode, I worked out that if you have $2.75 million of super, you can spend $120,000 a year and never run out of money. In fact, your super balance continues to increase, which means mathematically you could live forever. So if you're already there, why would you take the risk? What is it worthwhile taking that risk? Is it really going to change your life? And I think a 70% probability is worth taking that risk if you really need to. But in your situation, based on what you've told me, you don't really need to. So why would I do it? Another way to consider it would be, or another alternative would be, instead of saying 450,000, because that's a reasonable amount of money, why don't you do a smaller amount? And even better, why don't you do it progressively? So why don't you go and borrow 240,000, invest $10,000 a month over the next 2 years, and just let that do its thing. That way you're reducing the amount you're investing, you're kind of reducing your risk. But I'd still come back to my original conclusion is it's not really going to change your life. The growth that you get off that, it's not really, maybe it's something of a little nest egg you might want to invest to hand over, pass on to your daughter or something like that. So if there's something other than funding your own retirement, it might be worthwhile, but I'm not sure I would necessarily take the risk of $450,000, particularly if you think you're going to take the money out of super to reduce the debt. The other thing is I like the fact that you're maximising concessional contributions, and I like the fact that you're putting your savings into super through non-concessional contributions. That's just a really tax-effective environment to do that, particularly if you believe you're going to work to 60. That's the most tax-effective way of really building wealth, and it's good to accumulate in that fashion. And of course, because it's tax effective, even if you do want to accumulate additional monies to hand over to your daughter at some point, doing that inside super is completely fine as well. Remember, there's no restriction on the amount that you can take out. There's a minimum, but there's no maximum. So you could say, well, let's put some more into super with the idea of maybe giving a gift to my daughter when I'm 65 or something. You should be parking those monies inside super just because it's so tax effective to do that. So hopefully that gives you a bit of an idea, Lincoln, and thanks so much for your question. It's a really good, thought-provoking one. Okay, next question is from Adam. Adam writes, my question relates to a transition to retirement strategy. I'm 57 years old and have a healthy super balance of $2.4 million. Well done, Adam. That is a very healthy super balance. I love work and still plan to work to 65, but I'm thinking I might slow down a bit from 60, enjoy the last 5 years and start a transition to retirement, which is allowed in Australian super. Of course, that must be his industry fund. I've been fairly high growth with all super in shares and ETFs. What would be a good strategy in approaching the TTR, transition to retirement strategy? I'd only put maybe $500,000 in transition to retirement, withdrawing 10% per annum. How should that money be invested? I've kind of paraphrased there a little bit. So for people listening, transition to retirement means that you can access your super even though you're not retired. you've got to meet your preservation age. So that is, you've got to be older than 60 years old. But really, if you're between 60 and 65 and you're still working, you're able to access super. You can take up to 10% per annum of your balance out. So there's some restrictions. The money that you take out won't be taxed, so it'll be tax-free. And there's no tax benefits of starting a transition to retirement pension inside super. So there used to be, but that changed many years ago. So the only reason to do it is what Adam's highlighting here is that, you know, he wants to work beyond 60, but maybe not as much. So he might go down, he hasn't said it, but he might go down to 3 days a week, for example, and he might need some additional money to fund living expenses to help him do that. And so starting a transition to retirement is fine in his situation. And because he's got so much super, I don't really have any concerns about him doing so. That is starting to eat away at that balance. So his question is, if I put $500,000 in transition retirement account, so therefore he's got 2.4, which means in today's dollars he'll have 1.9 in accumulation still and $500,000 in transition to retirement. He's asked about the asset allocation. Well, with a unitized product like Australian Super, they need to deal with all the liquidity issues and those sorts of things. And also, because it's only really around 20% of your balance, I don't think you need to worry too much about volatility and asset allocation. So I'd be inclined to invest that in a premixed balanced option, for example. Adam's asked about, you know, should it be in cash or something more something conservative like that? I don't think so, Adam. I mean, it just depends on your risk tolerance, but I think a balanced asset allocation, given that it's only 20% of your overall balance, I think you can kind of ride out that risk. And if you're only taking, $50,000 a year out, well, you might have to sell down $50,000 in a market that's terrible. But, you know, if you're going to do it over the 5 years' time, I think it will really smooth out. So I wouldn't overthink it. I'd keep it balanced. At least you're exposed to earning some returns on that balance. Okay, next question is from Greg. Greg writes, I'm wanting your thoughts on a retirement strategy. Appreciate you can't give me specific advice. That's right, Greg. And in fact, everyone that's listening, you know, I can commentate on what you tell me, but of course I don't necessarily know everything. So please, if I do answer your question, don't take it as specific advice. There might be stuff that is important for me to know that I'm not aware of, but I do my best, you know, just to give you an idea of kind of what I'm thinking. Okay, Greg writes, I've been listening to your podcast and I thought I knew a bit about financial management, but realised the timing of things can be important. Thanks for your very informative podcast. I'm 61 and 1 year into a 10-year retirement plan. My wife is 50. So I'm guessing here that Greg's going to retire when his wife is 60. We are renting, not rent investing. We have 2 houses in Sydney rented out and are looking to buy our 3rd investment apartment on the lower north shore of Sydney. One house we bought in 2007 for $615,000 is now worth $2.6 million with a mortgage of $1.2. The other house bought in 2018 for $2.75 million is now worth $3 to $3.25 with a mortgage of around $2 million. I think it's a good example to show people compounding growth of investing in property, of course. Greg's got 5.8 million of property with, you know, 3.2 million of mortgages. So heavily indebted, of course, but, you know, the growth has been there. Cash will remain stable at roughly $850,000 per annum. I'm assuming that might be income, but I'm not really sure. Anyway, Greg writes, my plan is to spend the 10-year retirement phase contributing to super. For at least the last 18 months, we've been contributing $7,000 a month to super. Current balance is $540,000. Returns are exceeding contributions. The aim is to get the balance over $1.2 million, which is estimated based on a conservative return of 6%. He's with Host Plus. My aim is that the total assets will be over $6 million by age 70. My financial planner calculated the necessary contributions. Obviously, there will be non-deductible, so non-concessional contributions, as our concessional cap will be exceeded. His questions are, 1, does contributing to super make sense? 2, what should be the timing of the property sales? And 3, my offset account saves $4,000 a month in interest, which is a bonus, but I'm not paying down the mortgage. Oh, okay. Cash remains stable of $850. Maybe Greg's got $850,000 in offset account. That probably makes more sense. I'm paying down the mortgage. That is what I understand. I should leave till retirement, but my timing on this might be a problem. So he's asking about, should he be repaying debt? Okay, so if he's got 10 years to retire and he's got these assets, obviously these assets have demonstrated capacity to grow, although, the one that he's bought in 18 hasn't been owned for long enough, and the market's been, particularly in Sydney and Melbourne, for instance, market's been pretty rocky since 2018, not a normal market, if you like. Whereas if you look at Queensland, since 18, it's really kicked off. It's returned more than 10% compounding. That's not an issue. I'm not saying there's anything wrong with the property. It's really just a timing issue. Okay, so what should Greg do in his situation with his 10-year retirement strategy? Well, my first observation is his super balance is really low. And so even if he goes and sells the properties, let's ignore what he does over the next 10 years. If he goes and sells the properties when his wife's 60 and can access super, what does he do with the money then? The answer is, well, it'd be good to get some of that capital inside super, but he's going to be restricted on his ability to do that using non-concessional contributions. So I think one of the things that he wants to think about, he should be thinking about, is that over the next 10 years, where is my equity owned? At the moment, he hasn't told me, but I'm assuming the properties are personally owned, whether jointly or individually, but they're in personal names. And that's where most of his wealth sits. And he's got a relatively small amount of wealth inside super, 540,000. I imagine that's combined balance or whatever that is. So certainly that's my first problem, is that in retirement, I want to be as tax effective as possible, of course. And it's okay to have some assets in personal names because we can each individually earn $20,000, $30,000 and really not pay too much tax at all. So I'm not too worried about having some assets in personal names, but I don't want 80% of my wealth in personal names, of course. So that would be the attraction for me, to make those non-concessional contributions and get as in return for not repaying the loan and get as much money inside super. Of course, you'll get the negative gearing. That'll help you in terms of the holding costs. Interest rates will probably come down over the next 10 years. Like the average interest rate over the next 10 years is probably going to be lower than today. So I wouldn't have any sort of knee-jerk reactions to where interest rate settings are at the moment. So I think, and again, I haven't done the numbers, I think I would much prefer to make non-concessional contributions into super and build my super balance, even though I know that's coming at the cost of having the ability to reduce debt. And if you've got that $850,000 in offset, if that's what you're suggesting, if I've read the question correctly, then you've already got a big enough cash buffer. In fact, I would say probably more than enough cash buffer against the mortgages. I would get all the money into super. The next question would be, okay, where are you going to live post-retirement? So I know you're renting at the moment. Will you continue renting, or will you occupy one of the properties that you've purchased? Because that will then tell me which one will you need to sell. Of course, you wouldn't contemplate selling until you're retired, I should say, when you've got a full income tax year, full financial year where you don't have any salary income. And that'll help you minimise, to some extent, the level of capital gains that you make, or the capital gains tax you'll have to pay. Won't have a huge impact, but at least have some impact. So I'd certainly do that. And then you need to then think about, okay, what are you going to do with those monies post-retirement? Well, you'd leave some in personal name, as I said. Then maybe you could even shift some in a company if you had, substantial monies. Because then you could quarantine the tax rate at 30% and then gradually move more of those monies inside super if your balances and the rules and so forth allow it. So if I go back to Greg's questions then, does contributing to super make sense? Yeah, absolutely. What should be the timing of the property sales? Not really sure. It's going to depend on market conditions. at the time, but I would say certainly you wouldn't want to sell, particularly if you think these assets are going to continue to perform until you're fully retired, just to minimise capital gains tax. And then beyond that, really depends on how you're going to use these assets. So if you're going to occupy one of the properties, for instance, that'll make some of the debt non-tax deductible. I think that would suggest that you probably sell sooner rather than later, the other asset. If you continue renting, then maybe you've got a little bit more flexibility. And in terms of repayment of debt, I think, as I've said, I would prioritise super contributions over repayment of debt because you've got, I'm assuming, a very large cash buffer, $850,000 in offset accounts, so you can weather any storms or changes in income. And if you're comfortable with that level of exposure, then I would suggest you continue with that indebtedness level in return for boosting your super. Okay, I think that's all I have time for today, and until tomorrow, bye for now.